If you live in the Northeast and you've got a mortgage, the war in Iran could decide when your interest rate falls. Oil prices have already moved, and that feeds directly into inflation, mortgage costs, and your investments. In this video, I'm going to show you exactly how global conflict can filter through to your personal finances in Sunderland, Newcastle, Durham, and Teesside. Let's start with oil. Roughly, a fifth of the world's oil supply moves through the Strait of Hormuz. So when conflict threatens that route, markets react, and quickly. Oil prices tend to move first. When oil rises, it rarely stops there. If you drive to work every day, you run a van, manage deliveries, fuel is the obvious pressure point. But it doesn't stop at the petrol pump. Higher oil prices affect delivery costs, food transport, flights, manufacturing, heating. That weekly shop in the Northeast, the one that already feels a lot heavier than it did just a few years ago, is more exposed to geopolitics than most people realise. That's how a regional conflict becomes a domestic cost issue right here in the Northeast. So if you're a tracker mortgage or your fixed rate ends this year, this is the part that matters. Interest rates are shaped by inflation expectations. Energy-driven inflation slows the pace of rate cuts. Mortgage relief could be delayed. Now, that doesn't mean we're suddenly heading back to crisis-level interest rates, but it could mean that they end up staying higher for a bit longer. And in the Northeast, where income growth doesn't always keep pace with parts of the South, that's a difference that can really make a difference. It's a chain reaction that starts with oil tankers in the Persian Gulf and ends up affecting your monthly mortgage payment right here. Now, let's talk about investments. Because if you've checked your ISA or your pension recently, you might have noticed some added volatility. That's normal, especially when geopolitical shocks happen. Markets react quickly. Stocks often fall initially quite rapidly, while assets like government bonds or gold can rise as investors search for something that they feel is a bit more safe. But here's something history shows time and time again. These shocks are often temporary. Markets tend to recover once uncertainty begins to settle. That pattern has repeated across multiple global conflicts over the last few decades, which is why experienced investors focus on discipline rather than reacting emotionally to the headlines. Short-term volatility can and will feel uncomfortable, but it's also normal. Have you noticed volatility in your investments recently? Let us know in the comments how you're handling that uncertainty. This is where diversification becomes really, really important. If your portfolio is properly diversified across different regions, sectors, asset classes, you usually have less to worry about when events like this happen. Diversification exists for moments like this. It spreads your risk. It prevents one event dominating your entire financial plan. And if your investments are actively managed, meaning the professionals are adjusting exposure as conditions change, that can add another layer of resilience. Now, active management doesn't remove risk, nothing does. But it allows a portfolio to adapt. And if you're not sure how your portfolio is structured, periods like this are often when people realize they might have been carrying more risk than they thought they were. And understanding your exposure creates more confidence. Now, if you run a business in the Northeast, particularly in transport, manufacturing, hospitality, or construction, I don't need to tell you that your margins can feel exposed. Fuel, imported materials, utilities, they can move and cost really rapidly when energy prices rise. And the question becomes pretty simple. Do you absorb the cost or do you pass it on to your client? But that one decision shapes profitability, hiring, any expansion plans you might have. So periods like this are a prompt. Review cash reserves, revisit fixed versus variable borrowing, stress test your business's cash flow, and check your portfolio for diversification. When you understand the mechanism, you can make calmer decisions, and calmer decisions tend to lead to better financial outcomes. So global conflict can feel distant here from the Northeast, but its financial effects won't be. Understanding these connections help you make better decisions during uncertain times. If you found this helpful, subscribe to How Money Really Works for more financial education that cuts through the noise. Which of these things have surprised you the most that I've explained today? Let us know in the comments below. And remember, this is financial education, not personal financial advice. If you need help with your specific situation, please speak to a qualified financial advisor. See you soon.